here. Welcome to the oil and gas investment debate. It's very topical. So just like, I guess, set a baseline. So currently 60% of transport and half of that's cars use oil and gas to get around the place. So the other half is planes and trucks. So there's this big debate about I guess the future, which is really EVs versus the driver of global oil demand from socio-economic mobility. Very technical. So that's the 3 billion people in India and China. You're living in a hut and want to buy their first motorbike and get going, or they want to get some sort of transport. Are they going to be buying EVs or a little second-hand petrol motorbike? Now the other 40% is used in industrial use, like for plastics, chemicals, heating. So let's just park that for now. So I've had some, I guess what prompted me, this is a question today, but it's been around in my head. So, hey Rudy, what do you think are the best companies to invest in, considering the Australian government's target to cut all carbon emissions to 0% by 2050? Good on you, Elbow. Normally I'd agree with you about commodities, but the whole energy sector runs on fossil fuels, so losing the domestic market would hurt. What about green hydrogen? I guess, so my response to that, because I think that's fair, that's what probably people think, is we mean absolutely diddle dip. We could shut down everything we do in the whole world, in the whole of Australia, and make no impact to energy demand and no impact to climate change. We're a nothing. We're big in size, land, but we're nothing. So really, in my opinion, we're just shooting ourselves in the foot by walking down this path. Sorry to those who believe in it. So this helps just set a tone. I remember, I think the last time I did an oil video, a subscriber, he's a smart man, Mr. Michael, says he's just been in China. Over 50% of cars on roads are EVs. ICE cars, industrial combustion engine cars, will go the way of the dodo. The biggest complaint I hear is charging time. Right now the tech and infrastructure in Oz is still a little raw, so we'll be holding off until the sodium batteries are mainstream. They never run out and charge time is quick. My understanding of sodium batteries is they're heavy and they don't give you grunt. It was only just last night I was listening to some dude who's in this space in India and saying the Indian motorbike driver doesn't like sodium batteries because they can't get off the stoplights, when you go from red to green. They said they're too slow, which is interesting, and I do know they're heavy, so I don't know about sodium batteries. Another thing too is if every household has an electric car and is charging it in home, it's basically going to double our electricity requirements. So where's that going to come from? Because I don't think solar and wind are going to double our electricity supply. And then obviously there's the cost. Okay, so let's put that aside, Rudy. So and that all comes, it forms this beautiful picture which the financial markets are saying. So this is a graph of bullish oil bets. So bullish oil bets fall to a 17-year low. So this is, so up here is people, investors are bullish. They were buying oil. Right now we're at historical lows. So it's hated. Nobody wants to invest in it. So when's a good time to invest? When things are cheap, when things are hated. It's just the best way to try and make money long term is to buy things that are hated, and not chasing. Like gold before wasn't loved, now it's getting loved. I still think it will continue to go up. Anyway, and this is another little interesting start chat for you. So this is total US oil inventories. Let me see if you can. So basically this is 2001, 2009. So just keep this in. So 2009 to 2015 is this period here, and then it peaked up here. So US oil inventories are at all time, well, you can call it very low. Okay, so that's obviously a positive thing. Now, so remember this 2009 to 13. Okay, so we'll get on to what I like to do, the charts. Okay, so we got oil. Let me bear with me. Okay, so the oil price. So 2009 to 2013, the oil price was rising, while that inventory was flat, and now they're low. Okay, so historically we're at a low point, and so here's our first wedge. Okay, so break, it come back, and it's doing the retest, and the retest is forming into another wedge. And that wedge is falling into another wedge. Alright, so now we go to a daily chart. Now this is a 10-year investment, but I'm just trying to, I don't know, saying we're at the bottom of wedges. And short term, so we've broken. So I'd expect oil to pull back. I don't know, this week, whenever, 2 weeks. That it wouldn't be surprising to have a pullback, and then off she goes. Okay. Now some ratios to get your head around. Okay, so this is the ratio of oil to gold. Okay, so just like you have a gold silver ratio, which tells you should be selling your gold and buying silver now. So up here, so this is when you'd wanted to sell your sell your oil and buy gold. And we're now getting down, I'm not saying do this, but it's just showing you that oil is extremely cheap compared to gold. Okay, so if you're following the theory, you'd sell your gold and buy oil now. But I'm definitely not saying to do that. I'm just trying to show you that from a commodity price-wise, oil is really cheap. The other ratio, so the US oil to the S&P 500. Okay, so we go back in time. So back to the 1930s here. So here oil was really expensive to the S&P 500. And now look, we're extremely cheap. You know, we see a bit of a double bottom here compared to the S&P 500. So there's so many things indicating that oil is undervalued right now. Now the other guy is natural gas. Now again, I was going to say probably more bullish on natural gas because of things like data centers. They're going to need energy. Well, that's where 40% of natural gas is used for electricity. So this is currently 30% for making Freddo frogs. No, that's so industries, making stuff. Buildings 20, transport 10. Anyway, I think you can see historically natural gas is extremely cheap and forming one of those wedges within a wedge. So there's a few. So how can you play it? So there's some ETFs and there's some stocks. We'll probably end up with the conclusion, but we'll go through. So obviously, the king of the ASX is Woodside, which we put out this week. So top holding in the tank MVR. Well, I've talked enough about him. He's a buy. But one thing I don't think I have shown why Woodside. So this is a ratio of Woodside to the natural gas, because Woodside is predominantly a natural gas producer, not oil. So the Woodside to natural gas ratio. So historically, Woodside is cheap compared to the current natural gas price. Another one on the ASX. So I'll just go through the ASX stocks and then some ETFs. So we've got Santos. So again, they're large, sort of got the same product mix as Woodside. But I should just say, 6.9%. That's after this jump dividend for Woodside. Santos is 5.5, but he's only 60% franked. Oh yeah, sorry, we're going to have to divert just for a little bit, because I mentioned to someone about franking credits, and he had no idea what I was talking about. So so if you do, bear with it. If you don't, So franking credit. So imagine you get a dividend of $1,000 in the bank. Okay. So because that company's paid tax on it, there's a thing called a franking credit. So you basically get a credit for the tax the company's paid. And it's worked out as this formula here. It's 0.7 because the tax rate's 0.3. Anyway, you get a 42.9% franking credit on that. So on $1,000, there's a $429 credit. Now it's not cash. So what happens is, at tax time, in your income, you declare $1,429, and you pay your normal tax on that. But then you get to take $429 off your tax bill. But people in super, because if you're in a pension fund in super, you don't pay tax. So that's why they love dividend stocks, because basically they lodge their tax return, they pay no tax, and they get that $429 paid to them as a refund. So that's franking credits. All right, sorry about that. So where did we get to? So we're talking about Santos. So same product mix, but lower dividend and less franking. Then I like to do the, just get rid of them, the ratio charts to, should I buy this stock or that stock? So this is Woodside over Santos. So that's a break of a bit of a wedge there. So my preference is Woodside over Santos. I think better share price, better dividend, better franking credit. Now there's other ASX stocks. So you got Beach. They're 50-50. Oil and gas. Div 7.2. So I like that setup. And there's Karoon. It's another one. Now these guys are basically all oil. So there's a bit of oil kick for them. And I don't, their div's only 4.9, and there's no franking, so, but for diversification, and then we've got Horizon, which is more of it's paying a 14% div, but there's no franking credits. They're a mid-tier. I don't like that chart pattern terribly. So conclusion there is really Woodside would be your call. Now there is another option. So this is was one in one of my, I think the RTP, the Rudy's resource themed portfolio, fuel, which we added. So I started that in May. So this one's basically made up of 35 global energy companies, more geographically diversified, more vertically integrated than Australian. Because our companies basically just produce it, they don't refine it and turn it into petrol. So there's no ASX stocks in here. The distribution, I think I checked that last night, 3.9, so we'll call it 4. But because they're foreign companies, there's no franking credits. Franking credits only come from companies that pay Australian taxes. So we'll just quickly go through. So it basically holds. So before we go back, so from a chart perspective, it's just consolidating, ready to go. Well, to giddy up, a slowly paced giddy up. Technical terms. So the biggest, so Shell, so that's a really big broadening wedge pattern there, which is extremely bullish once broken. Exxon Mobil, so I'm sure you've heard of all these. They're pretty big names, consolidating right at the top. Chevron, so it's what we call a bull flag. So there's your flagpole, there's your flag on resistance, bang. Then we got TTE, Total Energies, so they're just range bound really. Canadian Natural Resources, nice little bullish wedge there. BP, I'm sure you've heard of them before. Okay, so it's a bit of a Woodside channel going on there. Enbridge, so they've broken out of this wedge, doing a bit of a retest now. And ConocoPhillips, I'm sure you've heard of all these names. Okay, so they're the major companies sitting in that fuel ETF. So it's pretty solid. I mean, that's all I can say. Now, if you do the comparison, so Woodside, say, do I buy Woodside or do I buy fuel? Okay, so this is the ratio, Woodside over fuel. So fuel has actually been outperforming Woodside because it's coming down, because the denominator is bigger than the numerator. So I could argue that that's a a declining wedge, which is bullish when broken. Okay. But obviously, if you're going to invest in the space, you just can't put all your money into Woodside. So fuel would make a good addition. So the divs aren't as great as Woodside, but I think they're all pretty solid companies, so you'd be pretty happy investing in that. Or if you're over in America, there's an ETF XOP, 52 holdings. They're mainly US based. This again, so 40% oil, 50% natural gas, 10% refining. So there's more companies than fuel, so there's lower weighting. But I love the chart pattern. A bit of a cup with a handle there, so it's not a bad one. If we just have a quick look at who's sitting underneath it, so we've got CNX. Now a lot of these names aren't familiar to us because they're mainly American based, not global. Anyway, these are a Canadian natural gas company, looking fine. EXE, so they're a merger of Cheapsake and Southwestern, so they're an oil and gas mix. Chart's looking fine. And we've got Murphy Oil, so they're a fuel gas station from refining, so they make profit from refining margins. They're not in production. Again, bullish setup there. EQT. Okay, so they're the largest US gas producer. So they're broken out of this little wedge here, so they're looking fine. And we've got Range Resources. So they're an oil and gas producer in the Apache Basin. So that's doing alright. And we got Dino, so they're a Texas-based petroleum refinery marketing company. That looks really nice. Look at that bullish pattern. Okay, so we do the comparison. So Woodside over XOP. So that shows Woodside's actually cheaper than XO. It's cheap relative to XOP, so you'd think you'd want to be buying Woodside, but it's a diversification thing though. So this is saying Woodside's cheap compared to XOP. All right, so what does that all mean? So I reckon you got to not overweight it, but you should have some oil and gas exposure because everyone hates it, so that's a good time to buy it. And there were some options for you to do. All right, let that soak in, give us your feedback, and have a good weekend.